Today we will discuss about company pricing and product costs. This is Amina. Amina wants to open a bakery that sells strawberry cake. Amina wants to determine the price of one cake, so she wants a 50% markup and she adds that to her raw material cost. To make one cake, she needs flour, sugar, eggs, butter and strawberry, to which she get the price 3 ringgit per cake. This is called cost-based pricing. Hi Amina, it's great that you want to open a business. Hi Amir, thank you. Can you teach me about fixed costs and variable costs? Imagine that you're opening a restaurant. You would need a loan, which you will pay interest for, you would need a mortgage, and you would need car payment. This is what we call fixed costs. It is also called overhead costs and it usually covers administrative, maintenance, and management expenses. It occurs every month with a fixed amount. Other costs to open a restaurant includes labor, packaging, and raw material. It is called variable costs. Variable costs vary when the output varies and it has a direct link with production. Now let's look into why cost needs to be considered. The first one is customer price sensitivity. It is customer awareness of the cost windows or range they purchase depending on market environment. $500 for groceries can seem expensive, while $500 for a phone can seem inexpensive. Next is company goals. It is profitability act as a metric for revenue maximization with fewest possible costs. For example, a shirt with a cost of $50 can't be priced at $25 because the gross profit margin is too low. Next is competitor. It is the cost analysis of rivals that includes a prediction of competitors' unit costs. There are a few factors to consider such as their strategy, their expenses and financial, and their competitive position. Next is economic condition. It can be used to project growth and make prediction for future endeavors. For example, when the economy is facing expansion, 20 ringgit per packet for cookies is considered cheap because people have high purchasing power. But when the economy faces inflation, the 20 ringgit packet of cookies can seem expensive because people have low purchasing power. Next is legal and regulation. Raw materials, advertising, marketing, labor are the most visible impact of government regulation. For example, if the government decides to increase the price of raw material, then the selling price of product will also increase. On top of that, pricing objective is also a factor. It governs the product's pricing. For example, if the pricing objective is to maximize short-run profit, then the company would advertise the company's product very heavily. The last one is product life cycle. It is the process of estimating an asset's total cost of ownership across its useful life. Let's say you purchase a new copier at $5,000. It would need a setup and delivery cost which is $250. The copier would need ink and paper that would cost $1,000. Moreover, it would need repairing costs which cost about $500. The copier would cost an interest on the credit card which is about $25 per month, and the depreciation of the copier would be $200 annually. It would cost $400 to remove the copier. This sums up for the life cycle cost of the copier to be $9,000. Oh, I see. When should we use this strategy? This strategy can be used when you want to justify and maximize profit. Let's say there is an increase or decrease in the price of your product. Cost-based pricing is really easy to justify the changes in your price. When to use this strategy is when the cost is more than the value. This happens when only cost is considered in order to cover the expenses and budget of the product. Cost-based pricing strategy is suitable to use when the costs fluctuate. It shows the instability price of costs and it is flexible enough to adjust the price. For example, if the price of wet food is always changing, then the price of a meal that was prepared from it will also change. Next is lack of market info. Cost-based pricing strategy is suitable to use when you don't have a lot of info on the market. There are a few questions that you can ask yourself such as who are your competitors? What is the marketing cost? Who are the suppliers? And what is the competitor's price? If you are not able to answer this question, then cost-based pricing is the way to go. This strategy can also be used when value is not a concern. Its purpose is only to sell product or services with no additional value. Things such as maintenance, packaging, and customer service is not taken into consideration. Next is cost leadership. This is when a company projects itself as the cheapest provider of a product or services. For example, we have competitor A with the price point of 50 ringgit, competitor B with a price point of 23 ringgit, and competitor C with a price point of 14 ringgit. In this case, competitor C has cost leadership. This strategy can be used when other competitors use it. Competitors use this strategy so the firm become a follower in the market. On top of that, it is also used to cover costs. If the costs increase, the price increase. But if the market share is large, then the price can be lowered. Now that we've understand when, let's look into who should use this strategy. The first one is manufacturing business. Companies choose cost-based pricing method because they are straightforward and it assures that important expenses are paid. For example, the manufacturing cost for a phone is $2,000. The company wants to do a 20% markup, which leads to the final price of $2,400 for one phone. With large volumes of manufacturing, it is easier to use cost-based pricing method. Next is small businesses. They do not need complex calculation to determine the price of their product or services. For example, Ali has a banana store. He should determine the cost, set a profit margin percentage, and just calculate the final price. This strategy is applicable to retailers because it is more traditional and acceptable in stable markets. Products with low value should also use cost-based pricing because it is easier to price them. Last one is low brand products. When it comes to low-cost product, people are more impulsive than when it comes to rationalizing high-cost purchases. For example, in China, the cost of labor is cheaper, thus they're able to produce product with cheaper costs. There are 10 characteristics of cost-based pricing. The first one is transparent. The second one is it is low in risk. It is also predictable in the future and it is fair to the customer. It is also considered cheap and it is simple and easy to calculate. It is also adjustable and it is very flexible to implement. It is very cost-oriented and it can also be easily justified. Now let's get into 3 optimization model. So what is price optimization model? It is a mathematical system that analyzes how demand changes at different price levels. For example, we have 5 different cans of beans. The only thing that differentiates them is the branding, the packaging, and the price point. There are 3 price optimization models. The first one is promotional price model. It is when a company temporarily reduces the price of a product or service to attract prospects and customers. For example, Pizza Hut buy one free one and Zalora Black Friday sale. Imagine a girl going to shop for a handbag that is priced at $250 in 2019. But in 2020, the price of the bag dropped to $150. This is called the initial price model. Last but not least is the markdown price model. These price models usually happen at end year sale. Stuff like shoes and clothes and bags are on sale to up to 70 to 80%. It helps business with short life cycle products such as fashion trends and seasonal products like airline, hotels, and specialty retailers to sell their product. I want to do cost-based pricing for my product. What benefit would it give me, Christina? Oh, I see. Sure, John. Let me explain. The first one is it reduces price war. Price war is a competitive exchange among rival companies who lower price points on their products. For example, Company A versus Company B. Both of them are selling white t-shirts. Company B sets the price lower than Company A. Cost-based pricing allows the amount of price to decrease because it is set only based on cost. Another advantage is its transparency. Customer can get behind the idea of a certain price point and it is easy to calculate. With the right markup profit, every sale can generate profit. The next advantage is it reduces price gouging. Price gouging is the occurrences when businesses raise their price to a certain level that seems unfair to consumer. For example, in 2019, the demand for masks and sanitizer is low, which causes the prices to drop. But in 2020, after COVID-19, the prices raises up because the demand increases. This strategy only focuses on costs. Another advantage is low risk price decision because costs have been fully covered in the final price. On top of that, it also gives a consistent rate of return, which means that net gain or net loss of an investment over a specific period of time. Last but not least, it is flexible. If the cost increase, then the price can be increased. The next advantage is that it encourages shopping. This pricing strategy allows firms to set a price point that attracts customers to shop more. On top of that, the price is certified. The only difference is the profit margin because costs are already calculated in the price of the product. For example, if Company A wants to price 150 ringgit and Company B wants to price 100 ringgit, the only difference is the profit margin, which is 50 ringgit. The next advantage is fair to customer. Customer will either pay more or less depending on the cost that were being used to make the product. For example, a customer can choose between buying from flea market or from an actual retail store. This pricing strategy is also non-discriminatory. It means that everyone from any demographic segmentation will have to pay the same price. Apart from that, it is easy to differentiate. Different businesses or brands would have different pricing strategies. The next advantage is suitable for most products. Consumer goods are suited for this strategy while luxurious brands, however, are not suitable. It is also suitable for most services. It is widely used by industries such as advertising, building construction, engineering firms, and utilities. The last advantage is price leadership. When a firm has strong influence in the market, it can determine the price of a product by using this strategy. For example, firm A, B, and C will look up to firm D and set a price based on firm D. Now that we have looked into the advantages, let's look into disadvantages. Let's go! The first disadvantage is when the cost is low, the profit will also be low. This applies to raw materials especially. It is also not for all businesses. Cars, property, and luxury products are not suitable. It is also ignore willingness to pay. When people want to pay more, the company will ignore it. Moreover, this strategy will also ignore demand because it is purely based on cost, so it missing out opportunities to get more profit. Apart from that, it also ignore competitors because it is purely based on cost, it missing out the opportunities to get more profit. Moreover, miscalculation can happen because the profit can be too high or too low. On top of that, in this pricing strategy, the value can be ignored since the price is set based on cost. On top of that, the risk of price of cost changing is constant. Another disadvantage is no guarantee of profit. With little to no market information, it is hard to justify that the final price will eventually become a profit. Now, let's look into the cost-based pricing strategies. The first strategy is cost plus pricing. It is when a company determines cost of the product to the company and adding a percentage on top of the price to determine the selling price. For example, the cost to make a shirt is $30 with a 50% markup, the shirt will cost $45. The second pricing strategy is markup pricing. It is the method of determining a product's selling price by adding a percentage to its cost. The first characteristic is markup is added into the total cost to cover the cost. The second characteristic is markup is added to the cost price, usually equals to retail price, and it is straightforward to implement. Let's look into the pros and cons. The pros are it is simple and easy to implement, and it reduces the cost of decision making. For the cons, it promotes operational inefficiency, it does not consider competition, and it is not future oriented. Let's look into the calculation. ABC Corporation manufactures table with a markup percent of 15%. By using the formula of unit cost, we get the price of $9. Now we need to count the markup price. The markup price is calculated with a total of $1.35. And last we calculate the selling price, which is the unit cost plus with markup price of 10 ringgit 35 cent per unit. Next, we go into profitable pricing. It entails determining product prices in order for the firm to profit from each sale. For example, a businessman wants to open a bookstore, so the production cost is 100 ringgit. He adds that to the retail cost of 100 ringgit through website and retail store. In total, the price of one book would be 300 ringgit, including the price of production and retail costs. A few characteristics of this pricing strategy is it can be predicted just by knowing the cost of the product. It is also can be classified as a profit-oriented price. It is a simple and easy pricing strategy. The pros for this strategy is it is simple and easy to implement, and it can gain customer trust easily. The cons for this strategy, it can easily overprice product and it ignore other additional costs. EFG Corporation puts out dresses. The cost is $5,000, production of 200 units, and a markup percent of 20%. First, we need to calculate the unit cost, which amounts up to $25, price, which amounts up to $5. And last but not least, we need to know the selling price, which is the addition of the two previous costs, which amounts up to $30 per unit. Next, we move on to target return pricing. It is based on the amount invested in a given endeavor plus the investor desired return adjusted for time value of money. We will look into the money that was invested in the product or services. Then you would set a target return, in this case about 15%. Then the target return pricing is set in a specified period of time. The characteristic of this strategy is the price is chosen in such a way that the company profits aim is attained if sales continue at the current rate. The second one, it is designed to generate a specified rate of return on investment, typically expressed as a percentage of sales. The pros is effective and optimal usage of resources inside the organization, and pricing competition is limited. But the cons is unreasonable load on the manufacturing department. In order to attain profitability, they need also increase the number of items they sell. An example is a tractor maker. The investment is $200,000, rate of return of 20% with a cost of $100 and expected sales of 50,000 units. To get the target return pricing, the unit cost need to be plus by desired return times invested capital divided by unit sales, which amount out to 108 ringgit. It means that we need to sell 50,000 copies with price 108 ringgit to get 20% return. Next is break-even pricing. It is the amount of money for which a product must be sold to cover the cost of manufacturing or providing it. For example, if the cost of raw material is $5, then the price would be set at $5 to reach break-even point. There are three types of pricing strategies under break-even, which is equilibrium, zero profit, and zero loss. Equilibrium pricing is the state in which market supply and demand balance each other, and as a result, prices become stable. The characteristic is that it avoids any surplus or shortage, and it does not change unless the demand towards the supply requires changes. The pros for this strategy is it determines minimum point of price, identify the minimum equilibrium and applicable in various companies. The cons are practically impossible to reach the perfect equilibrium, does not help business financially, and is hard to calculate. For example, Necktie Corporation has price per unit for $4 and quantity in stock is 500 units. The demand is 500 units and the demand equals to quantity in stock, which means that 500 units equals to 500 units. There is no surplus or shortage because product is completely sold out, which reached the market equilibrium. Next, we go into zero profit pricing, which is entering or leaving a company industry that has exceptionally low or near zero cost of entry. For example, if the ice cream price per unit is 3 ringgit, then the cost to make one ice cream would also be 3 ringgit per unit. The pros of this strategy is the company can set up the lowest acceptable price and it can establish a market dominance. The cons is it is difficult to sustain in the market and it has a certain perceived value. The characteristic for zero profit pricing is the total cost of the expenses is equal to the total sales of the revenue. The price is acceptable even at the lowest price. A non-government organization sells keychains to gain charity. The fixed cost is $150, the selling price is $5 per unit, and the variable cost is $3 per unit. First, we need to calculate the break-even output, which is 75 units. Now we calculate the break-even revenue, which is $375. Last but not least, we need $375 to break even price point for the keychain. Next, we move on to zero loss pricing. This strategy penetrates the market by offering its product at a cheap price. For example, the launch of a chips is 30 cents. The reason why the price is so low is because it wants the customers to chase and purchase it in large quantities. Pros of this strategy is that it reduces the competition and it dominates the market. It is also an effective pricing strategy for a new entrant. But the cons is that it can be a price war if competitors also decide to do the same, and the quality perception of the customer will always change. The characteristic for this pricing strategy is the price is set up based on break-even quantity. The price will produce enough revenue to cover the cost at a given level of production. Let's look into MPL company. The information given are fixed cost, selling price, and variable cost per unit. In order to calculate this, we first need to determine the break-even output by using fixed cost divided by selling price minus variable cost. Then we determine the break-even revenue by using the break-even output times by price to get the price point for keychain. Next, we go to rudimentary pricing. Rudimentary pricing is divided into three categories, which is marginal cost pricing, full cost pricing, and direct cost pricing. Marginal cost pricing is the pricing strategy that sets a price that is just below the profit margin. The characteristic is it happens at the end of a year. Prices are calculated by adding the difference between the selling price and the marginal cost, and it clears out inventory. It is also known as product cost. The pros for this strategy is it increases profitability and it aids in short-term profit planning and is easily implemented. The cons are its fixed expenses are only stable for a specific duration and it is challenging to distinguish between fixed and variable expenses. The overhead recovery is also very high. Let's look into FlexFood. The variable cost, the overhead expenses, and the selling price is given. So a customer offered to purchase the extra 100 unit at its best price. By only considering the variable cost, the manager set the price of $12. So it generates a profit of $2 per unit. So the incremental profit is $200. Next, we go into full cost pricing, which is it incorporates all company costs into the pricing strategy. The characteristics are as follows. All direct, fixed, and variable overhead expenses are allocated to the finished product. More realistic profitability picture than variable costing. And the last one, it is designed to return a maximum return profit. Let's look into the pros. It computes all production costs and there is a possibility of profit. It is also very straightforward. But the cons, it is hard to compare product lines and the evaluation of cost volume profit is more complicated. For example, is YG Corporation. The production cost, the sale and administration cost, the expected profit and expected sales is given. We first need to calculate the full cost plus price, which amount to $18 per unit. So the price for an item is $18. Next, let's look into direct cost pricing. It is a price that is connected directly with the production of a certain good or services. The characteristic is quite simple to determine the cost object and direct expenses do not need to be constant. The pros of this pricing strategy is it provides management with information, it helps to prepare year-end budget, and it enables business to track changes. But the cons, it is rising in expenses and it only takes into direct variable and not overall costs. For example, let's look into Lee Company. The material, the labor, and selling price is given, and a customer offered to purchase the extra 6,000 units. By considering all costs, the manager decided to sell the extra quantity for $5. So $5 already include all costs, which means that the revenue is $30,000. These are our authors: Muhammad Fauzan bin Fadzil, Nora Amani, Nur Shazwina, Vera Nurmalasari, and Nadia Carmila.